Hey everybody, and welcome to the second and final video from chapter 1 of Money and Banking. And I'm really excited because today what we're really going to be doing is giving motivation for the rest of the course and why it's so important. And I know that you hear about it from all your teachers and professors, not just here at Purdue, but maybe even before that, about why their classes is so important and why it's important you need to understand it. But the difference with this class, in my opinion at least, is that we really can see the tangible impacts of when we get these concepts right and wrong. And these two crises in 2007 and 2020 really epitomize just how these concepts affect everybody, not just those of us that like to study financial markets. And so it's not going to be so much an academic experience as a human and personal experience as we go through this set of slides. We're not going to be talking about a lot of new concepts because of that, but it is also important to follow along and understand because we're frequently going to be revisiting the groundwork that we set in both of these crises later on in the course as we learn new concepts. So first, we're just going to be going in depth through the 2007 financial crisis or the Great Recession, and then we're going to talk about the one that we're still just kind of getting out of, the financial crisis that was caused by the COVID-19 pandemic. And so, for those of you that don't know, hopefully you all do, but in 2007 to 2009, not just the US, but most of the world went through the biggest post-World War II recession ever. We call it the Great Recession, and there's a lot of different causes and explanations for why it happened, but a lot of it is rooted in the American housing market. In particular, in the early 2000s, there's what we call a housing bubble, where the value of houses were growing quicker than people could pay them off. So they're overinflated in their prices. And there's a lot of different reasons we're going to get into that later on, but starting in 2005, we started to see this quote unquote bubble pop. If we look at the sale of new single family homes in the US, they fell by 80% in July of 2005 to July of 2010. And so we're just talking about a massive pop of basically houses were just booming in the US and pretty much in a couple of years went to no new houses were being constructed. Likewise, looking at just housing prices in general in the US, the index of home prices in America fell by 65% over the same time span. So we're talking about crazy drops in value in the American housing market. And one of the biggest reasons why this bubble formed in the first place that economists generally agree on is the growth of securitized mortgages through the mortgage-backed securities that we talked about in the last video. We call these MBSs. Uh, and to understand really the MBS market, we have to go back to 1968 when Congress wanted to promote home ownership. They felt that part of the American dream was owning a house, and they wanted to make it easier for people that didn't have phenomenal income to own a house. And so they created Fannie Mae and Freddie Mac. And what Fannie Mae and Freddie Mac were designed to do was to sell existing bonds to investors and to use those funds to purchase more mortgages from banks. And the reason why this was so successful in sparking the market is quite simple. Under the pre-existing system before 1968, when a bank gave a mortgage to a company or to a house, they had nowhere to go with that mortgage, and banks only wanted to hold on to so many mortgages, and more particular, they couldn't buy more mortgages. They only had a finite amount of money available to them, and so they were only giving mortgages to those with the best credit ratings that they knew were going to pay them back. However, Fannie Mae and Freddie Mac, what they were able to do was buy those mortgages from the commercial banks and sell them to investors and investment banks in exchange for cash that banks could then use to purchase even more mortgages. So it was very beneficial and profitable for banks to give out mortgages and then sell the ownership of that mortgage first to Fannie Mae and Freddie Mac, who then gave it back to the private sector, and the private sector could do what they wanted with it. In particular, make MBSs and mortgage-based derivatives. And mortgages and MBSs were deemed to be this godsend financial security because of their perceived safety. And their safety came from two reasons. First, that they trusted commercial banks to only give mortgages to very good and worthy investors. The other one was that MBSs, as I mentioned, had thousands of individual mortgages bundled together. So that meant that even if a couple people didn't pay back their mortgage, the MBS was still extremely valuable. So the idea was that they were getting a lot of interest return on the MBS with very low risk. However, since they were so well liked on financial markets, commercial banks started to run out of people to give mortgages to. And so they started finding people with lower and lower credit scores, making them riskier and riskier. And they put all of these mortgages from what we call subprime borrowers in these new, more modern MBSs. And while they were even more profitable because they were riskier, so paid a higher interest, there was also an increased risk in these MBSs that wasn't taken into account in the market. And sure enough, as the mortgages slowly were not paid off, the housing market started to slowly decline. We hit that critical point where just nobody wanted to buy houses and nobody can afford them, and the existing mortgages were going bust. And basically, overnight, the housing market crashed. Now, remember, a lot of large investment banks still held on to these absolutely worthless MBSs. And slowly, because of that, since investment banks made MBSs the cornerstone of their investing strategies, these investment banks started to go under with the mortgages and the rest of the housing market. And it became so bad that massive Goliath investment banks were starting to go under. And in April of 2008, one of the biggest and most famous ones, Bear Stearns, was teetering right on the edge. And the Fed stepped in because they feared of the economic fallout that would be caused by Bear Stearns going under. Now, this had a lot of plaudits and critics alike about whether or not it was the right choice. And the Fed backed it up by saying, look at what would have happened in our models if Bear Stearns went under. But a lot of economists were extremely critical because of the moral hazard problem, which broadly says that by letting Bear Stearns get bailed out, the Fed is signaling to large investment banks that they can make risky and stupid financial decisions without fearing the consequences. And this is what the moral hazard problem is. And they feared that it would just signal to other investment banks to continue to make risky decisions. And because of this, at least partially because of it, when another massive investment bank went under in September of 2008, the Fed did not bail it out, partially because of these same pressures. And when we look at the American stock market, a lot of people that don't understand the larger crisis think that the market collapsed starting with the Lehman Brothers lack of bailout and bankruptcy. And so in front of you, you see the S&P 500 in the 2000s, and I picked out the point in which Lehman Brothers started to teeter on the edge and go under. And as you can see, the stock market was actually pretty stable considering everything that was going on from 2005 to 2008. It did start to go down in mid 2007, but nothing crazy. However, after Lehman Brothers went under, the S&P 500 and the rest of the financial market went into free fall, and everybody was feared that there was going to be no end in sight. In a sense, what the Fed was worried about with Bear Stearns came true with Lehman Brothers. And so in October, Congress decided to step in with what was called the TARP program. And the idea of the TARP program was to give treasury loans to investment banks in return for their stock. In a sense, this is basically just a loan that Congress is trying to inject a ton of money into these investment banks so that they can A, buy off their debt, and B, that they can make new investments to try and kickstart the US economy. Now, as an interesting side note on the TARP program, this actually meant that the US government briefly partially owned some of the largest investment banks in the world. Now, don't worry, there's no moral hazard with this because the US government quickly got rid of it, but just an interesting side note for you. And there were a lot of other responses that the US government had for the financial collapse, but we're actually going to save those for later on because most of the later responses came from the Fed, which we are going to start slowly building as we can better understand what tools the Fed had available. But for now, we're going to shift to one that all of you should at least be aware we're in right now, which is the financial collapse associated with the COVID-19 crisis. And in mid March 2020, as COVID restrictions started to get imposed, the US financial markets collapsed again. And we're talking massive drops. The S&P 500 dropped 40% in just over a week. These were record-setting drops. Now, what was interesting about this was that there was nothing internally wrong with America's markets. If the imposition of these restrictions didn't occur, there's no reason to believe that the US markets would have collapsed when it did. And so, what the Fed did is basically they just tried to kickstart the American economy and generate artificial economic activity. And the biggest way that they did that was by reviving lending facilities that came from the 2007 financial collapse to give access to credit to these large financial institutions. Additionally, Congress created the CARES Act, which many of you may hear of, and especially those of you who are dependents, because if you are dependent, presumably you don't have a massive income, and so that meant you probably got a stimulus check, these direct payments to households. You probably got a few of them. I know those felt really good to hit my bank account. They also provided supplemental unemployment insurance. And the idea behind this was that right now, the existing unemployment structure in America is designed to give people short-term reprieve from, getting laid off or something so that they can still provide for their family in the short term while they're looking for a job. Now, the problem with COVID-19 was that we didn't want people going to work. The whole idea with these restrictions was to stop economic activity so that COVID-19 couldn't spread. And so, in response for that, Congress increased unemployment insurance benefits so that people could stay at home, be safe from COVID, and not risk, becoming homeless or not being able to get food. They also gave state governments substantial funds to fight the pandemic to make sure that money was no object. And then finally, the one that we're interested in money and banking is the Paycheck Protection Plan or the PPP program. And the PPP was regulated by the Fed. So this was an interesting directive by Congress and arguably a bit of congressional overreach. But the Fed was all on board with it. And what the PPP did is it allowed for the Fed to give loans to commercial banks who loan to small businesses. So for example, if US Bank lent, the Italian restaurant down the street from me $10,000 during the pandemic and it was shut down, the Fed would in turn lend US Bank $10,000. So the idea was just to get commercial banks excited to lend out money to investors and not have to worry about solvency. The Fed took it a step further because while the PPP was just for small businesses, they wanted to help medium-sized companies in the US as well, companies over 50 employees. So they made the Main Street Lending Program, which allowed the Fed to lend directly to medium-sized companies to cover any sort of problems during the COVID-19 pandemic and to limit companies from closing down. Now, what's really cool about the Main Street Lending Program and the PPP was that the U.S. Treasury covered any loans that were defaulted on. So, if $1 million in loans were defaulted on in the Main Street Lending Program, the U.S. Treasury would give the Fed $1 million in return. But partially because we're still in this pandemic, there are a lot of unresolved questions. The first one, is what is the long-term impact of increasing these unemployment insurance benefits? As we start to reopen again, what we're seeing is that a lot of low-wage, low-skilled jobs aren't quickly being filled. And that is because The American labor force is also seeing this as an opportunity to reorganize itself, to demand higher wages, better conditions, etc. So we could see a substantial reorganization and shift in working conditions in the United States because people were able to be unemployed for longer, and so they could demand better conditions. The next one, and we're going to talk about this later on, is that the Fed, they now own a ton of assets and debt to private companies. In fact, they own over $8 trillion dollars, and the Fed can't just permanently hold $8 trillion dollars in assets. At some point, it's going to have to sell that off. And it's going to be interesting to see how the Fed tries to sell all these assets off without flooding the market and just driving down prices for people that want to hold on to these bonds. And then finally, and we're going to talk about this in the next chapter, so this is a little bit of a prelude, is that as you could tell through this conversation, the Fed just uh, injected tons of cash into the market without really substantial concerns for the long-term consequences. And now that the economy is starting to reopen again, the economy is opening with a massive injection in money. And so there's starting to be some concerns about inflation. So it's going to be interesting to see how the Fed handles long-term inflation in the United States. But with that being said, you now have all the information that you should need to complete the Chapter 1 quiz. And feel free to talk to me if you have any questions or want to talk about either of these financial crises or anything that happened earlier than them.